Good. So what do option models do? And I think with what do option models do, the best thing usually is to look at examples. So let's look at an example here. This is a very typical question. It's kind of the easiest example I can think about. So we have a share. The underlying is a share, ABC. The share has a spot price that is currently trading at 80. I made it simple. There is no dividends. Remember a lot what we always have to do when we talk about options. We have to somehow calculate the forward price. So that's easy now with those numbers. Interest rates are 5% per annum. And what we are looking to value is a put. And here I was very explicit. A European style put. So the valuation methods we looked at are true for European style options. Usually at the beginning, it seems as if, American style options, they are much more complicated, they are much harder to value. In fact, most often it's not much difference between these values because most American options it makes no sense to exercise them early, therefore they kind of behave like European ones. But at least the models we looked at are done for European style options. So I have a put option, a European style put option. It has a strike of 75 and it expires in 6 months. So what is the value of this option given all that information? Okay, let's start. So what do we need to value? In order to value an option has a different value at expiry depending on where the underlying ends. And so what I need first an idea of how different how different the underlying price could be at expiry. That's what we call a distribution. Right? And here you see my distribution. Very simple. I said, okay, I believe that roughly we could end at 5 different prices at expiry from 53 up to 111. Remember, today spot trades at 80. And then the next thing we also need an idea of how likely it is that we end at those prices, and that together I call a distribution. Right? And you see here, I used exactly that simple method I showed you in the e-lectures, namely we assume that we have a middle price here, 82. I'll show you in a sec how we came to this 82. And there is about a 50% chance that we end there. It's actually the forward price. So there is a 50% chance that we end where the forward price predicts. Then there is a chance of about 1 divided by 6 that we end a little bit higher. There's the same chance, 1 divided by 6, that we end a little bit lower. And there is a chance of 1 divided by 12 that we end much higher, and the same chance that we end much lower, right? So that's in a certain way, at least these probabilities hardwired into our model. I call our little model the 5-stick distribution model because we have 5 possible values and this looks like 5 different sticks. Good, right? So that's how we did it. Then we said, okay, now that I know where spot can end at expiry, I need to translate spot prices into option values at expiry. And this is very, very, very simple because we assume that we are at expiry. Our put here, I think this is the hockey stick of a put, has a strike of 75. So, of course, if we end at 82 or above, the put will have no value. If we end at 67.5, The put is the right to sell at 75. The spot ends at 67.5, so the put is worth the difference, namely $7.50. Similarly, if we end at 53, the put is the right to sell at 75, so we are 22 better than the market price, so the put has a value of 22. Remember, you all did that. So from a range of possible spot prices, we came to a range of possible put values. And now, right, very simple, I just calculate the expected value of the option at expiry. So there is the option has a value of 0 with a chance of 1/12, 3/12, 6/12, about 9/12. And so there's a chance of 1 divided by 6 that the option has a value of 7.5. There's a chance of 1 divided by 12 that the option has a value of 22. So I add that stuff together, I get an option value, expected option value at expiry of 3.08. That's at expiry. Premiums are usually paid up front. So the next thing I will have to do is I have to present value my premium. And if I do that, remember we have 5% per annum interest rates, but this is a 6-month options. So I have to divide the 3.08 by 1 plus interest rates times a half, because it's a half year. So this is, I have to divide that by 1.025. Cool. What I get is a value of 3. That's exactly what you have done in this e-lecture, right? Very simple. And I'm not sure how much you appreciated that, but the cool thing is, hey, we get a value, right? Now, it's probably good that we briefly talk about how different are different models, right? There are actually many, many models. There are many, many option models out there. That option model I showed you is a purely educational model Vincent and I developed, right? So I wrote here, every option valuation model needs to assume a distribution, right? So a range together with likelihoods of expected future spot prices. At least if we have a European option, we only need that distribution at expiry, because you can only exercise the option at expiry, right? The only difference between models is how complex this distribution is. For example, there's a very, very famous model called the binomial model that more or less thinks stock can go up or down. Then I have here my 5 stick is saying at expiry we can end at 5 different spot prices. And then there are more complex models. For example, one that you might have heard about is the Black-Scholes model. That assumes, I show that later in an example, that assumes that the spot prices are continuous, right? I only said 5 different values, and Black-Scholes assumes more or less that prices or returns are normally distributed. Good. But you see, just to understand what the model is doing, a 5-stick model is actually good enough. Now, what we haven't actually talked about, and if I go back, maybe let me go back and you give me that answer, right? Let me go back here. That's always difficult if I go back that it gets too long here. Right, so here we started. There is actually one input I forgot. Can you spot which input I forgot? I mean, I got a value. Remember, I got a value. But what was the input I forgot here? Okay, let's see. See, that input is because what we need, and my chapter here is, I said here, calibrating the expiry distribution. I mean, an option lives in a world, right? A world with certain parameters. We have to make sure that my distribution reflects the current market environment. And the first thing, this is absolutely the most basic stuff. The expected future spot prices must equal the forward price. Remember, I did that in my distribution I showed you before. Here. What I put the 82, and remember 82 was actually the forward price. Why? The spot price was 80. The option was a 6-month option, and interest rates are 5%. So if you calculate that, 5% of 80 is actually more, is 4, but it's half a year. So half of 4 is 2. So the forward price would be 82. So I put that in the center of my distribution, and my distribution is very symmetric. You see here the probabilities are very symmetric. So also the expected outcome of the distribution, or let's say the expected spot price, is also 82. I mean, you can easily calculate that. 82 times a half plus 96.5 times 1 divided by 6, blah, 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 blah. You get 82. And that's very important. If this is not fulfilled, I wrote here, the expected future spot price must equal the forward price. Otherwise, arbitrage opportunities would arise from the option prices implied by your model. That means you put prices out and people could make free money out of your prices. Why? We haven't fully explained that. We will see that a bit more when we talk about put-call parity in the next session. So that's one thing. So very important. The mean of the future spot prices has to be the forward. And then the second one, right? Remember, my prices were between 53 and 116. I had a range. That range is somehow has to match the possible market prices in the future, or let's say it has to match the uncertainty about the future spot price. So which number gives me the or which characteristics in finance gives me the uncertainty, the fluctuation of a price? That's I know you know it. What number tells you how much prices fluctuate? Come on, say it for me. That's the volatility. Exactly. That's the volatility. Perfect. Good. Okay. So a question. And this question you can only answer if you actually watch the videos, but you will see I explain in a sec. How much volatility did we actually price into the option? Or let's say, how much volatility did our distribution represent? So in this number of 3, how much volatility is priced in? And then I had a second question. Is there a name for the volatility that is priced into an option? Okay, let's see. I go to the next page. Remember, this was how we actually did our 5-stick distribution. So we said our 5-stick distribution, and as I said, Black-Scholes will do something similar. We put the forward in the center, and then we said, okay, we could trade an interval. It was, I think, 14.5 or whatever I calculated here. I could put an interval higher, or it could trade spot twice that interval higher, or that amount lower, or twice that amount lower. Right? So actually, we always increase the prices by a fixed dollar value. Right? And here is how in the model when we talked about the 5-stick distribution, how we chose that interval. See, that interval has to do with volatility. Sigma is volatility, right? Volatility is typically given as an annual number. Now we scale it to how much time uncertainty has to move the spot price. We have half a year, so we multiply it by square root of a half, and then we multiply it by the forward, right? So this is a percentage number, these two things together. We multiply it by the forward, and this is our interval. So our interval is given by what is a typical amount the forward could actually differ from what we have put into that. Or you could say, what is a typical amount that the spot could differ from what forward predicts, right? And if I really do the numbers here, see, the interval was 14.5, because if you think about 82, 96, the difference is 14.5. 96.5, 111, the difference is 14.5. So the difference between the prices is always 14.5. And if I then calculate what is that implied volatility, you will see that the implied volatility, where did I write it? Didn't actually write it down. So, is 25%, right? So what we priced into this share is a typical annual price uncertainty of 25%. That's what volatility is, right? And by the way, some people wrote it on the chat before, volatility. So you can also, if this answer you can put in the chat. I'm not sure how explicitly we said that, but if an option has a value, our option has a value of 3, right? We calculated the put value is 3. The volatility that has been priced into the option, or how much volatility we would have to put into the model to receive that same price I see. Do you know how we call that volatility? You might have heard the name before. And either say it verbally or write it in the chat. Yes, implied. Exactly. So very good. So this volatility is called the implied volatility. So this option has an implied volatility of 25%. Fantastic. Cool. So there we have it. So our option option price is, or let's say spot price was 80. We had no dividends. Interest rates were 5%. The expiry is 6 months. Of course, the strike of the option was 75. And what we actually assumed is that the volatility is 25%. Cool. Now let me say a word about these different models. So what you see at the moment on the screen, I think you had something similar in the e-lectures. So you see exactly the same option, the 75 strike put, in the same market environment. So volatility 25%, interest rates 5%, that includes, or that implies, a forward of 82. If I now use a Black-Scholes model, and again, if you want to see a Black-Scholes model, there is a button in our e-lecture that brings up such a model. Black-Scholes model, the price is actually quite a bit different. It's about 10% difference, right? We get a difference, we get a price of about 3, and Black-Scholes gets a price of about 270. So Black-Scholes is more, let's say, an industry strength model, kind of, right? So it's an old model, but it was the first really robust option model. The reason why I use the 5-stick distribution, remember what we did. We just needed to calculate the distribution. We had 5 different values at expiry. These 5 different expiry spot prices created 5 option prices at expiry, and then we just had to multiply those by the probabilities and sum that up. Of course, if we have, like Black-Scholes, if we have something more a continuous distribution, it means summing up an infinitely large number of values. And you know from your math calculus, this was what we call integration. And I learned the hard way when I started to give courses in finance, in actually UBS, when you draw an integral sign in a course. That, let's say, makes most or tells most brains to just shut up. And that's why we thought it's much easier to do this with a 5-stick distribution. It's maybe not as cool, the prices, as precise, but it shows you much more clearly what's going on and the whole dynamic of prices, what's happening or so. You also have it with the 5-stick distribution, and that's why we stick to the 5-stick distribution. Another thing that you realize probably, that the Black-Scholes distribution, that is called the log normal distribution, that red line, is not exactly symmetric. It's a little bit heavy on the upside here, so it has a little bit what people call skewed, but that's also just little technical details. Cool. Okay, we talked about volatility. Now I would like to reiterate the difference between volatility and volatility value. We talked about that before in previous lectures, but it is an important difference. So first, let me again give you the main thing about volatility, right? Volatility is a risk measure. It tells you how the underlying moves. Actually, it tells you how unstable the underlying price is. And in finance, this is used as the preferred risk measure. I would actually say it's the most pedestrian risk measure. It's a very simple risk measure. It's the first risk measure you usually get introduced to, and it's still a robust risk measure. It's actually, if you only have one number to spend for risk is usually very difficult to grab. But if there is only one number you're allowed to store, then it would be that volatility. Volatility is the typical move, right? So typically, how much do the spot prices typically move within a day or within a year? Now, volatility is actually scaled to a year. When somebody tells you the volatility is 20%, then it means that stock typically fluctuates by 20% within a year. So it's the uncertainty that comes, the annual price uncertainty. Statistically, it's measured as a standard deviation. And now, just keep the word in your mouth. Standard deviation, typical move, right? It's just a mathematician's way to calculate a typical move. The cool thing about volatility, it's relatively easy to calculate. It's relatively easy to interpret. And because it's easy, it fits well into your belly. And if something fits well in your belly, then you can make sense out of it. What is not so cool about volatility, and I had that discussion actually this morning, we had another review call in something, and I talked about risk. And when I talked about risk and said stock is going up, And then somebody told me, but that's not the risk. Going up is not a risk. Just going down is the risk. And that is a little bit not so good about volatility. Many investors thinks about risk as pure the downside, but volatility does not distinguish between an upside move or a downside move. It's just exposure to uncertainty, and it tells you how big uncertainty is. Now, I like visual representation. So a typical way how you can visually represent volatility, and I show you a better picture just in a sec, is think about you had a graph. On the x-axis you have time, on the y-axis you have the daily returns, and every day you write down, you note down the return, and you see sometimes this is plus, sometimes it's negative. It looks like absolutely chaos, right? But actually there is some consistency in the chaos, in how much it moves. You see here the daily fluctuations are smaller, here the daily fluctuations are larger. Okay, that looks a little bit theoretical. Let me show you a real example. But before I show you the real example, maybe you try again to keep that in your belly. Volatility tells you how much does my investment typically move in a year, right? How much does the value of my investment, I should actually say, typically move within a year, or the price of my investment? Once you have volatility, you can scale it up and down. And maybe that's the next thing oh no, that's not the next thing, that comes afterwards. But what I have here is a real life example. So this is the value changes, kind of the returns of a Swiss pension fund portfolio, right? That portfolio has invested mainly in liquid assets, and so you can get a net asset value every day. And this is how the net asset value changed every day. Right? So you can see there were some days, oh, by the way, it's a very long period. This is a period of about 15 years or so. So 2008 until about 2022 or 23. And I mean, you can certainly see that there were periods where the market was calmer, and there were periods, for example, 2008, when we had the financial crisis, right, when there was a lot of fluctuation. Nevertheless, you don't see a day where actually that portfolio lost 50% or so, right? I mean, that would be too dramatic. And my question here is, and we will just keep that slide up for 20 or 30 seconds. Over the whole period, you see here, I mean, as I said, there are phases where we have more volatility, there are phases where we have less volatility. What do you think was roughly the volatility of the pension fund? The volatility of the value, or the value of the pension fund portfolio. How can we get that? Not so easy, right? But maybe another question is easier. Let me first ask you the other question. Volatility tells me how much the underlying moves within a year, typically, right? And of course, for us, this is a difficult question, because we as humans, we see so few years that it's very hard to get a sense of a typical year. But actually what you see here is days. Every line here, every point, these are daily returns. Every point is a day. So maybe the easier question is, what was over this period the typical daily price fluctuation? Okay, let me just do some guessing here. I mean, if I look at 2%, oh no, that's not 2%. I mean, 2%, that would be -2 or +2. a move of 2% we rarely saw, right? If I look at 1%, I mean, even 1%, most of the time, the move was less than 1%, right? Most of the time it's somewhere in here, right? So if you kind of guess where could this roughly be, I mean, very hard to say, but I would say something like maybe within plus and minus 0.5% was the daily fluctuation, right? Or a little bit less, something like that, 0.4, 0.5%. I mean, sometimes more, sometimes less, but that's about it. Typical means typical. Typical means a little bit like on average. Okay. Now, we already talked about that when we talked about volatility, remember. How does standard deviation scale with time? Volatility is an annualized standard deviation of returns. So how much the returns typically fluctuate within a year. Now, with our farmer method, we just realized that actually a typical daily fluctuation is about, say, 0.5%, 0.4 or 0.5%. 0.4 or 0.5, let's take 0.5, it's easier. 0.5% per day, a typical move. In what typical move does this translate per year? And you remember that. Volatility is not linear in time. Volatility scales with square root, right? If it's a typical move in one day, 0.5%, next day that could actually go up another 0.5% or down, and then together it's zero. So these movements could compensate each other, right? And that's why the square root of time. And if I now give you again this rule, I know this is a rule of thumb, and I think you should at least remember that. If you remember that, you already know a rule that all the traders know, right? All the trader knows is if I see a typical move per day of, say, 1%, then the volatility is 16%, because it's very easy to go from daily move to annual move. You just multiply by 16 to go from daily to annualized, and you divide by 16 to go from annual to per day. Right? That was the rule. And remember why we had this rule. Why 16? Well, think about how many trading days we have in a year. We have about 252 trading days. Now, if we take these 252, we need to scale with the square root of 252. What is the square root of 252? Nobody knows, but 256 is not far away from 262, and the square root of 256 tends to be, or actually not tends, is 16. That's why this rule of 16 is actually cool. See, why is it so cool? I'm sure you sometimes listen to the news, and at the end of every news program, you do it in Switzerland, you do it in the US, they bring you some markets. So for example, they say, the Dow Jones today fell by, say, 0.5%. And then you wonder, is this dramatic or not? And the answer is, this is not dramatic. This is just nothing. Why is it nothing? Because the typical index volatility is 15%. Now, 15% is a typical a typical daily move. 15% divided by 16 is about 1%. So any number they tell you, any percentage number that is lower than 1%, this is just within the typical noise. This is not a signal. But on the other hand, when they tell you, oh, the Dow Jones or the S&P moved by 2%, This is twice the typical move, roughly. Then you have to start to listen, right? Okay, that was my brief summary of volatility. So if we do this actually with our Swiss pension portfolio, remember we said roughly 0.5%. 0.5% times 16 is 8. And if I actually use all the math to calculate that, what the volatility was, it's 7.7%, right? So roughly 8%, more or less what you get. That is volatility. We have not talked about options. We have talked about the underlying, right? And here, by the way, there is again, my rule how volatility scales, right? Rules of thumb from a 1 day to a 1 year typical move, you multiply by 16. So if you have the typical daily, you want the typical annual. The typical annual move is what we call volatility. You multiply by 16. If you want the typical move within a month, and you have the daily, you just think about what is a month. A month is about 21 trading days. Or what is square root of 21? Nobody knows. But square root of 16 is 4 and square root of 25 is 5. So it's between 4 and 5. And if you calculate it, it's 4.6, etc., etc., etc. Right? Cool. Now let's go back to options. And now it gets cool, right? We have already seen last time when Vincent talked about the value drivers. Underlyings are volatile. They have a characteristic. They have a characteristic that they fluctuate. In options, that characteristics translates into dollars. So the more volatile the underlying, typically the more value the option has. So that volatility of the underlying trades or translates into a dollar value in options. And as soon as it has a dollar value, you can trade it. Now you can trade volatility. If you think volatility is going up, buy options. If you think volatility is going down, sell options. More or less, right? More or less. It's a little bit more tricky, but that's actually what we mean by volatility value. How much more value the option gets due to the fact that the underlying is volatile. Cool. And then a little bit about, I called it here again, talk the talk, right? Historic volatility. This is just measuring how much the underlying fluctuated in the past. Implied volatility, we just said that, we just had that. Which volatility justifies the observed option price is implied in an option price. That's a reverse calculation. You need a model to back that out, right? You see the price in the market, you need a model to price it out. And then the estimated or forecasted volatility, that's what you would like to know. How much volatility do we actually have from now to expiry? But that's something only you only know after the fact. Cool. Okay, yeah, we have another 15 minutes. That's good. Oh, not exactly, but close to 15 minutes, because I want to go back to where we started, namely option prices. And I want you to help me calculate some more option prices. For example, we saw the 75 put had a value of 3, right? And remember, the forward was at 82. The strike of the put was 75. The put is the right to sell. If the market is at 80 or 82, selling at 75 is not very thrilling. So this option was clearly out of the money. Last time, Vincent told you that out of the money option are pure volatility value. And you know what that means, volatility value? It just means, you could also I call it here opportunity value. I call it volatility value. This is just, at the moment, this option has no value, right? Not really true. At the moment, if we already had expiry, this option had no value because the market is at 80 or 82, the forward is at 82. The only reason why this 75 put has a value, because it could be that the market moves so much down that at expiry, the option ends in the money. So we are hoping that volatility is moving the stock price in the money of the option, right? But at the moment, that's all it has, right? The only hope is volatility. That's why the 3 is purely volatility value. But now let's go to the 65 strike call. Again, 6 months to go. Now, if the market is at 82, the right to buy at 65 is in the money. So this option, the 65 strike call, is in the money. Now let's use this distribution to calculate the option value here. So what would you do to calculate the option value? We would say, okay, we could end at 82. If we end at 82, then this option has a value of, what is it? 75 is the strike, 82, that is 7. We end at 7 with the likelihood of 1 divided by 2. Yeah, maybe think in your head what you would do going on, and then I show you the solution. Here it is. Right, so I forgot the. I thought I didn't do that. I thought I have the. Sorry for that mess I'm now creating. I thought I have the hockey stick, but now think about the hockey stick. Okay, strike is 75, right? If I now go to the 75 strike call, if we end at 82, it has a value of 7. Likelihood ending there is a half. If we end at 96.5, the strike is 75. We have a value of 21.5. Likelihood that we end there is 1 divided by 6. If we end at 111, strike is 75. 111 minus 75, that's 36. That's the value then. Likelihood that we end there is 12. So if I add all that together and divide it by 1.025, I get the value of the option. The value of the option is 9.84. Good. I mean, we are not surprised. This is an in-the-money option that is much more valuable than the out-of-the-money put. But now comes the interesting question. Vincent told us last time how to do that. What is the volatility value of the 75 strike call? Because we remember, an in-the-money option has 2 kinds of values. First, parity value plus volatility value. What is parity value? Parity value tells us how much the strike is better than the forward, right? Forward at 82, strike at 75. So the strike is 7 better than the forward. So by dealing through the option, by buying through the option, I'm automatically 7 better than the forward price. So the value of that must be about 7. But remember, the prices, forward prices and strike prices, are paid at expiry. Premiums are paid today, so I would have to present value that. So let me show you the calculation, right? So I said the parity to the forward is 7, but I want to know what is the value of that 7 in present value terms. So I present value that at 5%, I get 683. The total value of the call is 984. The parity value is 683. Now do the calculation. What is the volatility value of the call? The volatility value of the call is 3.01. And now we have seen this many times. We have seen it in the valuation lab that you have maybe done with the e-lectures. Vincent hinted towards that already last time. It seems that even our model reflects here that the volatility value of the call equals the volatility value of the put if the call and the put have the same strike. And of course, on the same underlying and the same time to expiry. And that's a law. Right? In the next e-lectures, we will see why this is a law. This is such a strict law that a model cannot afford to violate that law. So any option model you will ever see will reflect that. And if not, you better throw away the model. Then it's worthless. That's exactly why we need to make sure that the forward is in the center of the distribution, or more precisely, why the forward is the expected spot price, or must be the expected spot price of the distribution. Cool. Again, that's something we will look at much, much more carefully and have really a proof of that next time. Cool. But you probably realized that calculating option prices, even with our 5-stick model, is a bit tedious. And so we created a calculator for you. Right? So you have now 2 calculators. You have a Black-Scholes calculator and you have a 5-stick calculator. I will briefly show you those calculators and how to get them. Once we have these calculators, we can answer many more questions. So for example, the questions that just I thought we could do. We might not have time at the moment, but we could do. What happens if I go up with volatility, with a double volatility? Well, you probably know the answer, but you can check it later. I mean, putting more volatility in means that the option price will go up. It's not exactly clear in what way. Some option will exactly double in value, typically the at-the-money forward options. Other, it might be quite different. But then the other question that is quite interesting: what happens if volatility is going down dramatically? Well, also quite simple. If volatility goes down, then the volatility value of the option goes down. That means out of the money option, the value goes towards 0, the lower we have volatility. And in the money option, the lower we put the volatility, the more they converge to this, what we call parity value. So they will not converge to 0, they will convert to parity value, and so on. Which options have the biggest volatility value? Actually, if you try to do that, it's a bit a silly question, right? Of course, the more volatility you have, the more volatility value. But you could, for example, say, okay, which strike has the highest volatility value? And there you will see that the biggest volatility value are usually at the money forward options, have the biggest volatility value. So if the strike exactly equals the forward. Cool. Okay, I think that was more or less what I wanted to show you. Again, we could have played more with the model. At least what I would like to show you, for those who have not seen it yet, I show you briefly the model. So I will stop sharing the PowerPoint presentation and I will start sharing my screen. So where do I have that? Here, right? Here is my screen. And if actually, see this, okay, this is not the, this is actually the next module is the put call parity module. And you see there is a tab tools. If I press on this one, you find two calculators. One is the 5 stick and the other one is the Black-Scholes. If you open the 5 stick, let's briefly value the option we had. Remember, we had an spot was 80, time to expiry was a half, interest rates were 5%, we had no dividend, volatility was 25%. Okay, that already tells me the forward price was 82, that's right. It tells me the spot interval, so this difference between the prices is 14.5. And now I can start to value here my options. So say I want a 75 strike, 75 strike put we had first. What is the value? 3, actually 3.01, right? If I want the same with the call, 9.84, exactly our value. It's nothing more than a calculator. If you have the at the money options, so at the money forward call, at the money forward put. Let me first here do the put and here the call. And oh yeah, what you see over here, you see something very strange. I think that's also something Vincent showed us. At the money options, at the money forward options have the same value, whether it's a call or a put. Why? Because these options are both pure volatility value. And remember, I told you there's a law that the volatility value of a call equals the volatility value of the put, and so on. So we can now use these models to actually answer some questions you have.